In this class, we may see the introduction of accounting. First one, system of accounting. In accounting, there are two systems. One is single entry system and the other one is double entry system. In single entry system, this system has no complete record of business transactions done during a specified period. That is, no accounting rules will be followed under this system. For example, accounts maintained by petty shop and accounts maintained by sole trader, etc. Then double entry system. One account is given debit while the other account is given credit with an equal amount. Here under this system, accounting rules will be followed to maintain the accounts. Then classification of accounts. Basically, there are two types, personal accounts and impersonal accounts. Personal accounts can be further divided into natural persons account, artificial persons accounts and representative persons account. Then impersonal accounts can further divided into real accounts and nominal accounts. The real accounts can further divided into tangible real accounts and intangible real accounts. First one is natural person's personal account. An account recording the transactions with an individual human being is known as natural person's personal account. Example, Krishna account. Then artificial person's personal account. An account recording financial transactions with an artificial person created by law or otherwise is called an artificial person's personal account. Example, company's account, college account, etc. Then representative person's personal account. An account indirectly representing a person or persons is known as a representative account. Example, salaries account maintained by in a business. Then tangible real account. An asset which can be touched, seen and measured is tangible real account. Example, machinery account. Then intangible real account. An asset which cannot be touched physically but can be measured in value. Example, goodwill. Next, rules of double entry system. First, personal account rules, debit the receiver, credit the giver. Real account rules, debit what comes in, credit what goes out. Then nominal account rules, debit all expenses and losses, credit all incomes and gains. Then accounting cycle. In business, for every business, every transaction will be recorded. All the monetary transactions will be recorded in a systematic manner. First step is journal entry. After completing all the transactions, we enter all the transactions in a book. It is known in the form of journal entries. Then we group the recorded entries under the same head, that is ledger. Then we summarize all the recorded entries under one head, it is trial balance. Then in business they prepare trading and profit and loss account. From this account we may know the profit or loss during a certain period. Then at the end of the period it will be balance sheet will prepare. Okay, and from the balance sheet we may know the financial position of the concern. Then accounting concepts. First one, business entity concept. After registering a company in a name, then the accounts are prepared for the company itself, not for as the person who owns it. That is, the business is distinct from the persons who own it. Then, going concern concept. It assumes that the business will continue for a long time. That is, there is no end for a business. Okay, then the persons who running that business may change, but the business has no end. For example, if a father started a business, he runs, then after his period, his son continues the business. So, the person's has end, person's life has end, but business life has no end. Then cost concept. All the transactions will be recorded at cost price in the books. It means deducted depreciation from the assets yearly. Dual aspect concept. Each transaction is twofold aspect, one debit and the other credit. Then money measurement concept. The transaction should be recorded in monetary aspects only. We should not record the transactions in kilograms, quintals, meters, liters, etc. Then accounting period concept. The accounts will prepare for a particular period. In order to know for a particular profit, in order to know the profit or loss for a particular period. That is measuring the profits, incomes or expenses of the period only are to be considered. Usually the period is 1 year. Then realization concept. If the revenue is recognized too early or too late, the company would not project the right financial position. It would look more profitable or less profitable than what it actually is. The next is matching concept. Expenses incurred for a period are matched with the revenues for the same period to arrive as a reasonably correct measurement of the net income or net loss. The difference between the revenues and expenses is a measure of how effectively the management has utilized the firm's resources. Then the last one is objective evidence concept. All the accounting transactions should be evidenced and supported by object documents. That is, all the transactions, all the transactions should have documentary evidence to enter. Then accounting conventions. First one is convention of disclosure. Accounts should be prepared in such a way that all material information is clearly disclosed to the users. Then convention of consistency. An accounting method or procedure once chosen should be followed consistently from year to year. That is, we should not change the rules or procedures and the accounting method frequently. Then convention of conservatism. Any business, while recording the transactions, should anticipate no profit but provide for all possible losses. Then last one is convention of materiality. Only those events should be recorded which have a significant bearing, and insignificant things should be ignored. There is no formula for identifying material and immaterial events. It depends on the accountant discretion. Thank you.